G'day legends! You're tuned into Gold Jumper, the only place where we keep our eyes on the shiny stuff. Jump up and under, let's get into it, because the markets have been absolutely mental over the last few days. We are breaking down the gold price action from March 13th to March 16th, 2026. We'll look at the Iran war impact, why oil is surging, and if the US dollar is about to crush the party. Plus, we're checking the charts for death crosses and seeing if the Aussie RBA is about to hike rates on us. Before we start, this is for entertainment only. It's not financial advice, so don't go betting the house on it. So, the big question for the day is, are we looking at a massive dip to buy or the start of a proper crash? Let us know what you reckon in the comments below, and while you're there, smash that like and subscribe button. It really helps the channel out and keeps you in the loop with all the latest moves in the gold market. We've got heaps to cover from Wall Street to the local shops in Sydney, so stay buckled in for the ride. Starting with the price action, Friday, March 13th was a real roller coaster for our favorite yellow metal. Gold opened the session at $5,105.79, but things got rocky. By the middle of the day, we saw a session low of $5,072 as traders got spooked. It felt like a proper paper market flush where the big institutions were dumping positions to find some quick cash. Even with all the war news, gold was struggling to stay above that $5,100 pivot point. By Monday, March 16th, the price was hovering around $5,019.88. That's a fair drop from the all-time high of $5,595 seen earlier this year. It seems like the market is searching for a floor before the big Federal Reserve meeting later this week. Now is the time to be cautious in the markets. We've got to watch these levels like a hawk. The year-to-date performance is still up over 71%, so the long-term bull is still very much alive. Now, let's talk about the black gold, because WTI crude oil is causing a massive stir in the markets. Oil prices have been jumping toward $113 as the conflict in Iran keeps escalating. The big worry is the Strait of Hormuz, where a huge chunk of the world's oil flows through every single day. If that passage gets blocked, we could see energy prices go absolutely parabolic, which is scary for everyone. High oil prices usually lead to high inflation, and that's why the gold market is feeling so much pressure. We also saw the OVX, which is the Oil Volatility Index, spike up to 121. That is a crazy level of fear, matching what we saw during the pandemic days back in 2020. When oil moves $10 in a few seconds, it forces big funds to sell gold just to cover their losses elsewhere. It's a bit of a mess, but gold usually finds its feet once the initial panic selling in the oil market stops. For now, oil is the tail wagging the dog, and every headline from the Middle East is moving the needle. Moving on to the big boss of currencies, the US dollar index, or the DXY, is looking quite strong. The DXY has surged above 100.40, which is a major level of resistance for the greenback. A stronger dollar makes gold more expensive for everyone else, so it naturally puts a lid on any big rallies. We are seeing investors flock to the dollar as a safe haven, even over gold, because of high interest rates. The 10-year US Treasury yield is also creeping up toward 4.29%, which is quite high. When you can get a decent return on a bond, people are less excited about holding gold, which pays zero interest. This is the main headwind we are fighting right now, even with all the geopolitical drama going on overseas. But don't count the gold out just yet, because these dollar cycles don't last forever in this debt environment. The US national debt is nearing $39 trillion, and that's the real long-term story for the dollar. Eventually, the market might lose confidence in the paper, and that's when gold really starts to shine again. Let's crack open the technical analysis and look at the 1-hour chart for some short-term clues, traders. On the 1-hour time frame, we are seeing a strong sell signal across almost all the major moving averages. The price is stuck below the 20, 50, and 100 period simple moving averages right now. The RSI, or Relative Strength Index, on the 1-hour chart dropped down to 34.08. That is getting very close to the 30 level, which usually means the asset is getting properly oversold. We might see a little technical bounce from here if the buyers decide this dip has gone far enough for now. The MACD is sitting at minus 1.03, showing that the bears are currently in the driver's seat. Stochastics are also sitting down near 22, confirming that we are in a bit of a short-term hole. We need to see gold reclaim the $5,100 level to prove the bulls still have some fight. Until then, the 1-hour chart suggests we might see a bit more testing of the lower support zones first. Shifting gears to the 4-hour chart, the picture is a bit more consolidative, but still leaning toward the bears. The Bollinger Bands are starting to flatten out, which usually means we are in for a period of sideways trading. Right now, the price is hugging the lower band, which shows that the downward pressure is still fairly persistent. The parabolic SAR dots are sitting above the candles, which is a classic signal for short-term bearish momentum. We need to see those dots flip below the price action before we can get excited about a proper trend reversal. The 4-hour RSI is at 38.38, which isn't quite oversold yet, leaving room to drop. Resistance on the 4-hour chart is sitting firm at $5,250 per ounce. If we can't break that level, we might just keep bouncing around in this range for the next few sessions. Support is being defended at the $5,000 mark, which is a huge psychological line in the sand. If that $5,000 level fails, the next stop could be way down near $4,900. Now, let's look at the daily chart for the big picture, because this is where the long-term trend lives. Despite the recent pullbacks, the daily chart shows gold is still trading well above its 200-day average. That 200-day moving average is sitting way down at $4,042, mates. This means the overall bull market is still technically healthy, even if the last few days have been rough. The daily RSI is sitting between 44 and 56, which is basically a neutral zone for the market. It shows that investors are a bit undecided about which way to jump next after this massive yearly rally. We are watching for a golden cross, where the 50-day average stays well above the 200-day average. But we also have to watch out for a death cross if the short-term momentum falls off a cliff suddenly. For now, the daily chart looks like a constructive correction after gold reached those record highs in January. As long as we stay above the pivot of 4,987, the bulls are still okay. Let's talk about those famous investors and what they are saying about this whole gold versus dollar mess. Peter Schiff has been very vocal, saying gold is the only real alarm bell for the global monetary system. He reckons gold could eventually hit $10,000 or even $20,000 if the dollar confidence fails. Schiff is telling everyone to ditch their Bitcoin and get into physical bullion before the real crisis hits. Then we have Ray Dalio, the big boss of Bridgewater, who says gold is a necessity in a portfolio now. Dalio points out that gold is now the second largest currency in the world for central bank holdings. He thinks the rise in gold is a hidden message that the real value of paper money is melting away fast. When you compare stocks to gold, Dalio says the stock market isn't actually doing as well as it looks. He suggests that legends should hold at least 15% of their wealth in gold to protect their pouch. It's a pretty strong consensus from the big names that gold is the place to be for the long haul. The geopolitics are the main driver right now, with the US, Israel, and Iran in a very heated conflict. We saw reports of missile strikes on US bases in Bahrain and big explosions in the city of Tehran. President Trump has been warning Iran that they will be hit very hard if their bad behavior continues. He even claimed that the US Navy knocked out over 40 Iranian ships in just a 3-day window. This kind of war news usually makes gold fly, but the strong dollar is acting like a lead weight on the price. Traders are worried about the Strait of Hormuz being closed, which would be a total nightmare for global trade. If that happens, inflation will spike again, and central banks might have to keep interest rates even higher. It's a tricky spot for gold because it loves the fear but hates the higher interest rates that come with it. We're also watching Davos, where Trump mentioned a framework for Greenland that eased some trade tensions. Any sign of de-escalation usually makes gold pull back, as investors feel safe enough to go back into stocks. Closer to home, let's look at what's happening in Australia, because the RBA is looking a bit hawkish. The market is pricing in a 66% chance of a rate hike to 4.10% this week. RBA Governor Michelle Bullock said that every meeting is live and they won't hesitate to move if needed. Inflation in Australia is still too high, and the rising oil prices are making the central bank very nervous. The ASX 200 has dropped about 6% since the conflict began, as investors get the jitters. We've even got a bit of drama with our gold reserves, with a senior official jetting off to audit our bars. Senator Gerard Rennick has been making a fuss about whether our 80 tons of gold is actually in London. It's a bit of a political circus, but it shows that people are starting to care about physical gold again. For us Aussies, gold in local dollars is still looking strong because the Aussie dollar has been a bit weak. If the RBA does hike rates, it might support the currency, but it'll make life tougher for the average punter. Now, let's dive into de-dollarization, because the BRICS nations are making some big moves this year. They are testing something called the unit, which is a digital trade currency backed by actual physical gold. The prototype uses a basket that is 40% gold and 60% local BRICS currencies. This is a massive shift because it means these countries don't need the US dollar to trade with each other. China and Russia are leading the charge, and they now control about 50% of all global gold production. Central banks have been buying more gold than ever, trying to diversify away from US Treasury bills. The dollar's share of global reserves has fallen to the lowest level in 30 years, around 56%. This structural shift is why the big banks like JP Morgan have a price target of 6,300. They see a reserve currency paradigm shift, where gold becomes a tool for government-level trade again. It's not going to happen overnight, but the cracks in the dollar's dominance are getting wider every month. Even the legends on Wall Street bets are starting to talk about gold like it's the next big meme trade. They've been calling it the taco trade and piling into gold as a bet against the current US administration. Some traders are selling their tech stocks and moving into hard assets like gold and real estate to be safe. There's a lot of talk about buying the dip because they reckon the dollar is eventually going to hit a wall. To wrap it all up, gold is currently caught in a tug-of-war between war fear and interest rate reality. Short-term charts like the 1 hour and 4 hour are showing we might see a bit more downward pressure. We've got major support at $5,000 and resistance at $5,250. Geopolitics in the Middle East is the wild card that could send gold back to record highs in a heartbeat. The BRICS unit currency and central bank buying are providing a massive floor for the long term. Don't forget that oil prices and the DXY are the two big things to watch over the next few trading days. If the dollar breaks, gold will fly, but if rates stay high, we might be stuck in this pouch for a while. So, what's your move? Are you stacking more bullion or waiting for a bigger drop before you jump in? Let us know your thoughts on the $5,000 floor in the comments, and don't forget to like. Subscribe to Gold Jumper so you never miss a beat when the market decides to go for a massive run. Stay active, stay legendary, catch ya.